share prices of Clorox fell over 14% in pre-market trading on Friday after the company reported lower than expected second quarter fiscal year 2022 results and slashed its full year guidance. This is yet another quarter when Clorox has disappointed investors, making its banner year in FY20 disappear further in the rear view. Hi, I'm Kate from the Motley Fool, and I spoke with Daniel Fulber about what's driving Clorox stock lower and how to approach investing in the business given what we now know.
So I think understanding Clorox, it's important to set the stage and go back to 2020. So March 2020 hits, and Clorox just quickly becomes this story stock, which definitely benefited shareholders in the short term. But it's something that long-term investors should always be wary of, because once a stock starts getting caught up in a story, which as a side note, we saw with a lot of Cathie Wood stocks, for example, you quickly have this kind of gap between fundamentals and then what the stock price actually is, what the valuation is. So Clorox, the company, to no fault of its own, the stock price shoots up and then it quickly becomes this uphill battle that continues to last to this day. So if you look at Clorox's, and they're on a bit of a different fiscal year, it's July 1st to June 30th. So if you look at that kind of second half 2020, first half 2021 performance, it's just this blowout record year. And it just became impossible for Clorox to follow up on it. And then if you throw in inflation coming in and raising costs, their growth outlook is quite a bit lower for fiscal year 2022, which again will end June 30th of this year. You're seeing just lower profit, lower free cash flow. And in fact, for the last quarter that they just reported, they only reported a 33% gross margin, which was the lowest in 21 years. And that's coming off of a record high annual gross margin for, again, that second half 2020, first half 2021 year. So it's just a quick, sharp, brutal drop from just record to like these multi-year, multi-decade lows. And it's a really tough situation for Clorox to be in. Now you compare that to Procter & Gamble, which is projecting further, and they're on the same fiscal year as Clorox, so that does make them easy to compare. They're projecting just strong organic growth and combating inflation a little bit better than Clorox. So both companies upgraded their forecasted commodity price headwinds for fiscal year 2022 in their recent earnings call. And if you kind of crunch the numbers and do the math, you can see that P&G is only expecting that commodity price headwind, which is $2.3 billion, to be about a 3%. That's 3% of their projected revenue. Whereas Clorox's guidance, which was this range of $350 million to $500 million, now it's at least $500 million. That is 6.9% of revenue. So I think instead of just comparing the numbers, because they're different size businesses, P&G is way bigger, you got to put them in relative context. That goes to show just how much more severe these higher materials costs, shipping and logistics costs, how much they're really hurting Clorox's margins. And that leads us to free cash flow. I mean, both of these stocks are dividend stocks at their core. That's why people own them for decades. P&G is a dividend king, and a dividend king is just an S&P 500 component that has raised its dividend for at least 50 consecutive years. P&G's done it for 65, I believe. Clorox is a dividend aristocrat, which is still very impressive. That's a S&P 500 component that's raised their dividend for at least 25 consecutive years. But if you look at the dividend, what you want to do is support that with free cash flow, because that ensures that you're not using debt or hurting your liquidity on your balance sheet to support the dividend. P&G is projecting to pay out $8 billion in dividends in fiscal year 2022 and buy back $9 billion to $10 billion in stock, which just shows how much of a margin of error they have in case commodity price headwinds increase. They'll still have plenty of cash to support the dividend. Whereas this year, if you kind of scale out what Clorox is forecasting and what their free cash flow is probably going to be, it's very likely that they're going to have a deficit in terms of what their dividend obligation is going to be and what their free cash flow is. Now, that's not a big problem. I mean, they're going to be fine. They're going to still pay it and probably raise it. But it's definitely an unsustainable practice. It's something similar that we saw with Chevron and ExxonMobil in 2020 when they're just losing tons of money. And they're also dividend aristocrats and they want to keep that coveted title. So to do that, they support the dividend with debt, which is totally unsustainable. Again, those two companies got completely bailed out because oil and gas prices are at 7-year highs, so no problem. But Clorox, another big problem facing them for the next few years is management said that they expect gross margins won't return to those pre-pandemic levels for at least 12 to 18 months or probably longer. So yes, they ripped off the proverbial band-aid, so to speak, on expectations, but it's also looking like they're not going to have that 40% plus gross margin, 45% gross margin until like fiscal year 2024 or fiscal year 2025. And that's a big ask for investors because now you're basically telling them that the business is going to be declining and not as good. It's going to be this 5-year gap between where it was and hopefully where it's going to just recover to that point. So it's tough because there's not a lot of upside in even the medium term. Now, to compensate for that, you do get this growing dividend, and that is one of the advantages of a stock that not only grows its dividend, but when a stock is down, the yield goes up. So now Clorox's dividend yield is about 3.2%, which is a lot better than P&G's 2.2%. But again, I think P&G is handling the commodity price headwinds better. They're still growing, whereas Clorox is declining. P&G has enough free cash flow to support the dividend. They're buying back a ton of stock. So just from a dividend perspective and how much extra free cash flow they have, that really helps them sustain and grow that dividend. Another thing to look at is valuation. So P&G has a lower price to earnings ratio than Clorox. The one thing I will say is that I think a good thing for Clorox is that if they grow back this margin, and then if you kind of project out by fiscal year 2024, fiscal year 2025, if they're getting that same kind of 2019, 2020 performance, the valuation will start to look very cheap very quickly as they rebound their business, whereas P&G kind of has to keep growing to have a good valuation. So that is one kind of card that Clorox has in its back pocket, but again, that's uncertain. And there's an analyst question on their conference call that was like, okay, well, I mean, how can you give us an updated figure because you said longer than 12 to 18 months? And then the analyst also said you've been under-promising lately and kind of missing your guidance. When are you going to start giving accurate guidance? Pretty tough question. And Clorox had a just total wet blanket answer. They were like, we really don't know what this is going to be. We don't have an updated time frame for you, and we kind of just hope our guidance is right. That's like the layman's translation of it. So it's just tough for existing shareholders. There's just not a lot to look forward to. And another thing I'll add about management, because management is very important when times are tough. Their new CEO, Linda Rendell, came in September 2020, and she's been adamant the entire tenure she's had as CEO about leaning into what she believes to be this more permanent consumer behavior shift towards cleanliness, towards hygiene, and things like that. And that's come at the expense of higher advertising, which is higher SG&A, sales, general, and administrative expenses. Now, that would normally probably be fine for Clorox, but if you also throw in this 1-2 punch of inflation and higher SG&A expenses, that's a quick way to just completely crush your gross margin, which is exactly what happened. And if you're a basketball fan, you watch like the NBA All-Star game and Clorox sponsored this whole Clorox Rising Stars thing. It's cool. I mean, they get their name out there, but I just don't see any reason why they would do that. I mean, I don't think anyone's going to start buying more Clorox wipes because they see them sponsor this NBA All-Star game. So I just think it's okay idea, but just really bad timing. And that kind of goes into the reason why Clorox is hurting so bad right now.
So, what's the silver lining in the Clorox investor story?
I think the one good thing, if you're a new investor into Clorox, a lot of the damage has already been done. And that is an advantage when you're coming into a stock. It's a bummer for existing shareholders, but at least now they've just set expectations so low that if inflation pressures start to subside and they're able to grow that gross margin back faster than expected, maybe they kind of reel in a little bit of that advertising spending, and that helps gross margin too. And they get back to this point of supporting the dividend with free cash flow faster than expected. If all those things start to happen quicker than expected and maybe their valuation starts looking attractive, then at least new investors will have, I guess, a little bit less downside risk. I mean, at this point, it's just hard for things to get that much worse, especially when you have just management's guidance on the conference call being pretty depressed, honestly, was their tone, was just kind of defeated. I think that it's easy to start beating from here. Again, that's not really important if you're a long-term investor because you don't necessarily care as much if they are beating this quarter or losing the next. But I think it is a question you really have to ask, depending on your investment time horizon, because it just doesn't look like they're going to start rebounding for a few years.